Pettit Printing Company has a total market value of 100 million, consisting of 1 million shares selling for $50 per share. So there's a market capital of equity of 50 million, and 50 million of 10% perpetual bonds now selling at par. The company's EBIT is 13.24 million, and its tax rate is 15%. Pettit can change its capital structure by either increasing debt to 70% or decreasing it to 30%. If it decides to increase its use of leverage, it must call in its old bonds and issue new ones with a 12% coupon. If it decides to decrease leverage, it will call in its old bonds and replace them with new 8% coupon bonds. So if it leverages up, the cost of debt goes up, and if it leverages down, the cost of debt goes down. The company will sell or repurchase stock at a new equilibrium price to complete the capital structure change. The firm pays out all earnings as dividends, hence it is a zero growth stock, and this is a key point going forward. Remember, it's zero growth. Its current cost of equity, that is the rate on stock, is 14%. If it increases leverage, the rate on stock will be 16%. So if it leverages up, that means there's increased risk to the shareholders. Hence, shareholders will require a higher rate of return. So that's why we see the move from 14 to 16% if leverage is increased. If leverage is decreased, a reduction in risk, the rate on stock will be 13%. What is the firm's weighted average cost of capital and total corporate value under each capital structure? So I've set this up in a way that hopefully you can understand what's going on. The background here, market value is 100 million. We know that's comprised of 1 million shares selling at $50 per share. So there's a total of 50 million in equity, and then debt of 50 million at a cost of 10%. Hence the market value is 100 million. Firm's tax rate is 15%, and we know that the firm has an EBIT of 13.24 million. So now we want to identify the weight on debt, the rate on debt, the weight on equity, and the rate on equity under each of the scenarios. So with the leverage present, we know the weight of debt is 50%, and we know equity is 50%. 50 million in debt and 50 million equity is a 50-50 ratio. We know that the current cost of debt is 10%. It told us up here earlier, at a perpetual bond selling at 10% at par. And we know the rate on equity is 14%. So we can calculate a WACC of 1.25%. Below, you'll notice this area identified as formulas, and this just shows you the formulas associated with this range here. If the firm leverages up, it will go to 70% debt, and you can see that right here, increasing debt to 70%, or decreasing it to 30%. So leverage up is debt of 70%, leverage down is debt of 30%. We can simply get the weight of equity as 1 minus the amount of debt. So you can see 1 minus the amount of debt gives us the weight of equity, and you see that referenced here down below in this formula chart. We don't have to calculate the cost of debt and equity that's already given to us. If we leverage up, we know that it will cost 12%. And if we leverage down, we know that debt will cost 8%. Equity will go up to 16% if we leverage up. And if we leverage down, it will go to 13%. So we have all the information we need to calculate the WACCs for each of the situations. So presently the firm has a WACC of 1.25%. If the firm leverages up, the WACC will go to 11.94%. And if it leverages down, the WACC will fall to 11.14%. The other information we need here is to know that, well, we have EBIT, we can back out for tax, and we also know that this is a zero growth stock since everything's being paid out. So what that essentially means is our depreciation is being funded back in. There's no growth taking place. We're just taking equity, or we should say, think about it this way. We have depreciation, but any depreciation amount that's being saved from taxes is just going right back into investment, so there's no growth. And so there's nothing on the short-term working capital side. So to get the value of the firm, remember value then will be equal to the free cash flow divided by the cost of capital. In this case, to get the free cash flow, it's just simply going to be the EBIT times 1 minus the tax rate of 15%. And then we'll divide that by the WACC under each of the given states. So we can see the value of the firm is right at 100 million. It's actually off slightly, but it's close enough for this example. Then all we have to do is drag down. We can see that if we leverage up, the value of the firm will actually fall. It will fall to 94,254,255 million. And if we leverage down, the firm will actually increase in value to 101,000,023. So if we want to represent this in terms of millions, we can say it's equal to this divided by or we can increase to 2 decimal places. So depending upon when you look in the text, you'll probably see answers close to this, at least for leverage up, leverage down. So technically the value is a little bit over 100 million, but pretty darn close. So if the firm leverages up, you'll see 94.255 million. And if the firm leverages down, you'll see 101.023 million. So in this scenario, what should the firm do? The firm should decrease its leverage just by adjusting its capital structure. It increases the value of the firm by $1 million.